Consider this. In 2025, the S&P 500 delivered roughly 16% total return. In that same year, gold, captured cleanly through SPDR Gold Shares (GLD), was up around 60% on a total return basis. That spread is exactly why a 100% equities approach left real performance on the table. If your portfolio was all broad US stocks, you basically ended up with that 16% outcome. But if you held a simple, disciplined mix, 85% S&P 500 plus 15% gold, your 2025 return rises to roughly 23%. That's more than 6 percentage point edge created by one decision, pairing growth with a real asset that tends to win when rates, geopolitics, and policy uncertainty force markets to rotate. Now we're in 2026, and the best strategists aren't saying abandon AI, they're saying build a barbell. Gold is still being forecast to stay elevated in 2026, supported by central bank buying and ongoing diversification demand. And copper, the metal behind electrification, grids, EVs, and AI data center buildouts, just posted one of its strongest years in more than a decade, with major banks still projecting tightness into 2026. That's why a 2026 framework is taking shape. 20% gold, 10% copper, 70% AI plus tech, implemented through ETFs and high-quality equities, not physical metal. In this video, I'll break down the why, the how, and 3 lagging 2025 AI stocks that are positioned to lead the next leg higher. Our first pick in precious metals is gold. Gold works best as a structural allocation. It doesn't rely on earnings growth, innovation cycles, or valuation expansion. We first highlighted gold to our exclusive Patreon community over 6 months ago, not as a trade, but as a structural allocation. For 2026, a 20% weight reflects realism, not fear. Its purpose is simpler: preserve purchasing power when monetary systems are under strain. That's why many institutional frameworks now treat gold as permanent portfolio insurance, with allocations flexing higher when macro and geopolitical risks intensify. Gold finished 2025 up more than 60%, marking one of the strongest annual performances the metal has ever delivered. And this rally wasn't driven by hype or panic, it was driven by structure. Real interest rates drifted lower, inflation proved stickier than expected, and central banks continued accelerating their shift away from dollar-centric reserves. In that environment, holding cash or bonds became less attractive, and gold stepped back into its historical role as a store of value. Importantly, the most effective exposure isn't physical bullion. Gold ETFs provide direct price exposure, liquidity, and flexibility, allowing investors to rebalance without storage, security, or transaction friction. Here are the top gold stocks, ranked by YTD performance. Notice how these names have outperformed not only many high-flying, hyped stocks, but even gold itself. This is exactly why quality gold equities can deliver leveraged upside when the cycle turns bullish. Now let's shift our focus to the leading gold ETFs, and take a look at how they've performed over the past year and beyond. You'll see that many of these funds have also outpaced broader market benchmarks, reflecting strong investor rotation into gold exposure and resilience in uncertain markets. Copper, meanwhile, plays a very different but equally critical role. If gold is insurance, copper is infrastructure. Often called the metal of electrification, copper sits at the center of 3 powerful demand engines: the global energy transition, electric vehicles, and the explosive build-out of AI data centers. Every megawatt of AI compute requires enormous copper intensity, from power delivery and cooling systems to grid expansion and transmission. What makes copper especially compelling heading into 2026 is the supply side. New mines take years to develop, geopolitical risks are rising in key producing regions, and trade frictions are increasing pressure on refined copper flows. This creates a structurally tight market where demand growth doesn't need to surprise, it just needs to persist. For investors, the smartest way to gain copper-focused ETFs and high-quality mining equities. Broad ETFs provide diversified exposure to the metal itself, while select producers offer operational leverage, strong cash flows, and participation in long-term infrastructure demand tied directly to AI, electrification, and energy security. All right, now let's turn to copper ETFs. Here are the top 3 copper-focused funds. Let's take a look at how they've performed over the past year and beyond, and how they've outpaced expectations in a strong commodities cycle. Together, 20% gold and 10% copper form a powerful foundation. One asset protecting purchasing power, the other embedding growth at the infrastructure level, allowing the remaining 70% of the portfolio to take calculated risk where upside compounds. Now that we've built the real asset foundation, let's shift to the 70% equities portion of this portfolio, and the 3 AI and technology stocks that could define your 2026 upside. Let's start the equity sleeve with Microsoft Corporation, ticker symbol MSFT, a stock that perfectly fits my 2026 framework of strong fundamentals, muted sentiment, and asymmetric upside. While Microsoft remains one of the most dominant businesses on the planet, its stock performance over the past year has been surprisingly choppy. That disconnect is exactly what creates opportunity. Under the hood, Microsoft just delivered 18% revenue growth, with acceleration across both intelligent cloud and productivity and business processes. Azure continues to scale, enterprise demand remains resilient, and margins are still expanding at levels most companies can only aspire to. Yet despite all this, Microsoft trades near a 3-year valuation trough, well below its historical average multiple. Investor concerns, OpenAI dependency, Copilot adoption speed, and elevated capital spending sound serious, but when viewed through a long-term lens, they're transitional rather than structural. Enterprise AI adoption takes time. Microsoft's customers are governments, Fortune 500s, and global institutions, not consumers chasing trends. That patience builds durability. Capital intensity is another misunderstood factor. Management has been clear. Spending is tied to real, visible demand, not speculative capacity. And while margins may fluctuate quarter to quarter, operating profitability remains near record levels. When free cash flow reaccelerates, as CapEx normalizes, the market will likely re-rate the stock swiftly. For 2026, Microsoft represents pricing power, platform dominance, and AI monetization at scale. Now let's transition to the second equity pillar, Amazon.com Incorporated, ticker symbol AMZN, a company that does far more than the market currently gives it credit for. While Amazon has lagged many big tech peers recently, that underperformance masks one of the most powerful monetization flywheels in technology. At the core is AWS, which is reaccelerating as enterprises ramp AI workloads. Amazon isn't trying to win AI headlines by building the flashiest model. Instead, it's focused on unit economics, producing AI compute efficiently and monetizing it repeatedly. With custom silicon like Trainium and a growing emphasis on inference workloads, Amazon is positioning AWS to defend margins even as AI demand explodes. What the market often overlooks is Amazon's ability to monetize the same infrastructure multiple times. That AI backbone supports AWS customers, Amazon's own logistics and retail optimization, and one of the fastest growing advertising businesses in tech. Advertising revenue continues to grow faster than Google and Meta, driven by Amazon's unique advantage: monetizing attention at the point of purchase. Yes, capital spending is elevated, but it's backed by strong operating cash flow and long-dated contracted demand. Amazon has always prioritized long-term value creation over short-term optics. As CapEx normalizes and AWS margins stabilize, 2026 could mark the transition from investment cycle to cash generation cycle. The third and final equity in my 2026 portfolio is Meta Platforms Inc., ticker symbol META, and this is where AI monetization becomes immediate and undeniable. While many still associate Meta with the metaverse misstep, today's Meta is a completely different company. Meta has decisively pivoted away from speculative long-duration bets and toward AI that boosts revenue right now. In its most recent quarter, Meta delivered over 26% year-over-year revenue growth, driven almost entirely by advertising. AI-powered recommendation engines are increasing engagement across Instagram, Facebook, and Reels, keeping users on platforms longer and allowing advertisers to target with greater precision. The result? Ad pricing rose roughly 10%, proving AI is directly enhancing pricing power. Despite heavy capital expenditures on AI infrastructure, Meta's profitability remains elite, with industry-leading margins and exceptional returns on capital. That's because Meta's true asset isn't hardware. It's the family of apps used daily by billions of people. These platforms create a data advantage and network effect that AI models can enhance instantly. Valuation adds another layer of appeal. Meta trades at a discount to peers like Microsoft and Apple, despite faster growth and higher margins. At the same time, new monetization avenues, WhatsApp business messaging, AI agents, and smart glasses add optionality. For 2026, Meta offers a rare combination: AI that works today, margins that remain strong, and growth that's still underappreciated. So when you step back and look at the full picture, 20% gold, 10% copper, and 70% high-quality AI-driven equities, this isn't a speculative portfolio. It's a strategically balanced system built for volatility, growth, and compounding. Hard assets provide resilience, copper captures structural demand, and Microsoft, Amazon, and Meta anchor the AI upside without chasing hype. This is the same framework that worked in 2025, just evolved for 2026. And if history rhymes, disciplined allocation, not headlines, will once again separate winners from the crowd.